Welcome to a Mortgage Message Special Report, second quarter of 2016 edition. Because we've seen home prices do so well for the past 5 years in the face of media negativity, home buyers, realtors, mortgage loan officers, almost everyone is asking once again, is there a housing bubble? We've seen home prices kind of recover and come back to where they were before the housing crisis, and all of a sudden, people are unhappy with that. They think there's another bubble brewing. Well, I want to take some time with you today to offer this exclusive Mortgage Message special report that you can share with anyone and everyone connected to the real estate market. And I think it'll give them a sense of relief. Because we're hearing from all different sources now that perhaps it's not a good time to buy. So during this presentation, we're going to take a step back from the headlines and go step by step to show why this is still a great time to purchase a home. So is there a housing bubble? Certainly that's something that we're seeing and being asked. So the first step we want to do is we want to take a look at the jobs picture. And we compare the rate of unemployment that we see today as well as what it was during the beginning of the housing bubble. It was at 7.3%. But more importantly, look at what was happening. The unemployment rate was rising rather dramatically. Today, it's at 5%. But look at the trend. The trend is lower. I know we've had a slight move up here, but you have many of those along the way. As you can see, it's not a straight line down. The unemployment rate at 5% is certainly a lot better shape, and the trend is an improving one. And the labor market does remain tight. So from an employment standpoint, from a jobs picture, things look a lot better than where they were before. Let's take a quick look here on affordability. And this is a very important slide to look at because affordability is critical, and this takes a look at affordability throughout the entire country. During the housing bubble period, we saw affordability was indexed at 100, the lowest level we had seen. And you'd have to go all the way back to the early 90s, late 80s to get an affordability level that was worse than that. Now the best time ever? Well, that happened in 2012 when we saw an affordability index hit 208. And wasn't that a great time to buy? Once again, we saw similar levels in 2013. Another great time to buy, but it was a little bit more expensive. But lately, look at the move higher. The index is still at 175. Great affordability. Some of the best levels we've seen from an affordability standpoint. And much better than where it was during the housing bubble period. So from a national level of affordability, we think this is a great time to buy. And it really refutes any discussion of a bubble. And I also want to point out, by the way, let me go back, as a matter of fact, and talk for a second as to this affordability. While this is a national number, Mortgage Message can pull up for any area in the country. So wherever you're watching this from, please feel free to send us your city or town, and Mortgage Message would be more than happy to provide you with the affordability levels from the market in your particular area. Let's talk about housing starts. Now this is an interesting one because the media always wants to reference back to when we had 2 million housing starts. Now recently we've seen housing starts grow very nicely. Look at the trend of housing starts here. You see that it's been moving along at a nice steady climb, reaching a level of about 1.2 million annual housing starts. But the media is not happy with that. You see, they say, hey, look back. We remember when there was over 2 million housing starts. But is that what we really want? Do we really want to go back to 2006 when we had a glut in the market? That's not what you want. You want to go back to these healthy levels where housing starts are rising. But they're not overheating. And they're not at a level where too many homes can't be absorbed. So from a new construction standpoint, we're kind of a Goldilocks here. In addition to that, the media will tell you that home ownership rates are not doing well. In fact, they'll point to the fact that home ownership rate is as low as it was back in 1994. And you'd have to go back 48 years or so to see a lower home ownership rate, 49, even 50 years back, to get the low home ownership rate that we have. Is that a good thing or a bad thing? Well, when you take a look at the home ownership rates that are in existence right now, this is actually very bullish for the housing market, because there's an abundance of renters that can come into the housing market and purchase a home. When was it bad? When there was nearly 70% home ownership rate. because that created the housing bubble. There was no new renters that could come in. And this is a very contrarian kind of view that the media just doesn't get. We need to explain to our family, friends, and clients that low home ownership rates aren't necessarily a bad thing. In fact, it's a good thing. And high home ownership rates aren't a good thing. That's kind of a dangerous sign, because if too many people are in the home ownership category, that's too few renters, which means rental prices come down, which makes rent more affordable and more attractive versus home ownership. And in addition to that, there's fewer of those qualified renters to purchase a home. At these low levels of home ownership, you have an abundance of qualified renters that can continue the housing market moving in a direction of good, healthy appreciation. All right, next let's talk about home inventory. Now, the first thing we learned in economics was the law of supply and demand. And when you look at supply and demand, the first thing that you want to see is that if supply is low and demand is high, what does that tell you? Usually prices go up. And it's vice versa. If supply is high and demand is low, prices come down. Well, look at where we're at right now. We are at the lowest levels of inventory since 2012. And in fact, home inventory has been nearly cut in half over the past 5 or 6 years. So we're at levels that have not been seen since 2012, and before that, 1994. All great buying opportunities. If you're a homeowner in the market or a realtor trying to find a home for your client, then you know this. You're probably complaining about the lack of inventory. It may be a little bit harder to get a home, there may be fewer transactions out there, but it's very supportive of pricing. Now, when we see high levels of supply, like we did back in 2006 and 2007, that's when you can run into trouble. And the time before the most recent housing bubble where we saw high levels of supply, well, that was the previous housing bubble, 1986, 1987. So low supply, very healthy housing market. High supply, a little bit of a danger zone, and very much the potential for a bubble. So we are nowhere near that level right now. Things are looking very, very good in the housing market. The next thing is demographics, and demographics are really critical. You know, people like Lee Iacocca understood demographics very well, and when the baby boomers, who were the largest generation at the time, when they were in their early 20s, he created a Mustang so that they could enjoy those years with a top-down convertible or a sports car that was affordable. As baby boomers got older, started to have kids, he had the brilliant idea, maybe not the most stylish, of creating the minivan. And understanding how demographics work is extremely important for any corporation going into the future. So it's no different for us understanding how this might impact the housing market. So let's take a look. So we see here the different generations. The silent generation from 1928 to 1945, then the baby boomers from 46 to 64, and this was the largest birth generation ever in the United States. And then notice the births dipped a lot here for Generation Xers. In fact, notice this hole in the birth of the Generation Xers. Then it started to pick up again for the millennials. Millennials from 1981 to 1997, although there were fewer births, because all the baby boomers aren't still with us, in the past 6 months, millennials have surpassed baby boomers for the largest generation, population-wise, in the United States. Make no mistake, millennials are the new economic driver within the U.S. Now, when we take a look at what the numbers are according to Zillow, we go back and we see that Zillow tells us the average, or median, I should say, age of a first-time home buyer is 33 years old. And guess what was happening when we had the last housing bubble? When the births of individuals here were dropping, that just happened to be where the 33-year-olds were in 2006. So we had all this excess supply that we just talked about. But yet, demographically, births were too low to absorb that supply. And that's one of the big reasons we had this housing bubble. But now, where are the 33-year-olds? If you take a look at this chart, they're right at the beginning of this beautiful wave higher to rival the highest births ever among baby boomers. So we have a huge crop of millennials coming into the home buying age that will continue to put pressure on demand, especially when you have the low supply that we have. This is very supportive of prices going forward. I think this demographic chart is a critical one for us to keep in mind. Now, people also say we've seen appreciation throughout the United States at 5% or 6% or whatever it is. And when you think about this 5% appreciation level and whether 5% is sustainable or not, the media gets this one wrong a lot. Because the media oftentimes will say something like, incomes are not keeping up with this level of appreciation and therefore that's a problem. Well, guess what? Incomes have never kept up with the level of appreciation, nor do they ever have to, because there's a relationship between the amount of income that you earn and the amount of monthly payment. If you take the payment, just principal and interest, not principal, interest, taxes, and insurance, it's roughly 20% of the monthly income. That's what the typical relationship is. In fact, Fannie Mae and Freddie Mac say it's about 19 or 18%. So when we look at this and say, okay, it's about a 20% relationship, if the payment goes up, the income doesn't have to go up by the same percentage. It has to go up just by a fraction percentage-wise to keep up with that payment. So let's look at an example here. So let's just say a year ago, if you were looking for a home with a $1,000 a month payment, it's likely that your income was about $5,000 a month, making the principal and interest portion of your monthly income a 20% ratio. But what if you waited a year and that home went up 5% in price? What you'd be looking at this year, if interest rates stayed the same, is a payment of $1,050. How much will your income have to go up to match this? Well, it would obviously have to go up $50 a month to $5,050. But what percentage rise in income is that? Is that a 5% rise in income? No. It is up just 1% in income. And right now across the country, we're seeing income levels rise closer to 2.5%. So we could certainly support appreciation at the 5 or 6% level, even much more than that, closer to 10%. Although that might be a little bit too hot, as long as interest rates don't rise in a meaningful way. So this shows us that from an appreciation standpoint, it certainly is sustainable. And finally, let's talk about the quality of loans. During the housing bubble, we had all these buyers come into the market that really should not have been there. Heck, 580 FICO, 100% LTV, no income verifications. Those loans didn't make a whole heck of a lot of sense. But yet, so many people were buying homes, and multiple homes as well. I don't know if you saw the movie The Big Short, but there's a scene where there's actually a dancer that's asked about a home that they have, and she goes on to say, well, I've got 5 homes and a condo. That really wasn't out of the ordinary for what was going on at the time. It was so easy to buy a home, and people thought it was the thing to do. This was clearly a problem, especially when the weaknesses were exposed because it was so easy to get a loan. Again, 580 FICO, 100% loan to values, these weren't uncommon. And doing those loans with no income verification was not necessarily a stretch as well. Today, we know that the high quality of underwriting loans has resulted in a great amount of improvement in performance. The amount of delinquencies has dropped to just 3.2%, and that is a low that's been around for 8 years now. That's a great crop of loans that we continue to see each and every year. In fact, you could almost argue that the underwriting guidelines are too strict. The bottom line here for my mortgage message followers is this. The evidence is overwhelming that we are currently not in a housing bubble. Now, can things go wrong? Are separate markets going to react differently? Of course. These things can happen. But overall, by and large, the United States housing market is very healthy. You can argue it's been the bright spot of the economy, and probably will continue that way for years to come. Now, down the road, there's things that we can't see that could change a lot of that, but you could say that based on all the evidence and all the fact, forget the media rhetoric. This certainly appears to be a great time to be a buyer. Thanks for listening. I hope you enjoyed the presentation, and I hope you share this presentation with as many friends and family as you can, either through social media or otherwise. As always, this is Joe LaGiglia with MortgageMessage.com saying thank you for the opportunity to serve you.